Today, property pressures hit home. Hello again, it's Martin North from Digital Finance Analytics. Well, notice post covering finance and property news with a distinctively Australian flavour. Well, on Saturday, I went and visited a few of the auctions in the area that didn't happen. They were all cancelled. Interesting sign of the times, and that was reflected in an article in the AFR, who said that more than 2 in 5 Sydney homes failed to sell at auctions this week as expectations for further price declines amid rising interest rates prompted buyers to stay on the sidelines and wait for better deals, according to preliminary data from CoreLogic. Vendors are also losing confidence fast, with more than 1 in 5 scheduled auctions cancelled or withdrawn in the past week. That's nearly twice as high as the 5-year average of 12.5%. And meanwhile, more than half, actually 53% of homes were sold before auction as sellers rushed to make a deal rather than risk not getting a sale. I think these reflect falling vendor confidence. Otherwise, we wouldn't be seeing such a large proportion of auctions being pulled from the market without being rescheduled, said Tim Lawless, CoreLogic Research Director. The high proportion of properties sold before auction also suggests vendors are probably becoming less willing to test the marketplace under true auction conditions. Sydney-based auctioneer Clarence White of Mennick White Auctioneers said that there had been a marked decline in buyers' confidence since interest rates started to rise. Buyers are very cautious, and they're now factoring in further interest rate rises and potential price falls before they bid, he said. They're basically thinking if the property could be worth $200,000 less in 3 months, then they'd rather wait. So vendors are now forced to adjust their reserve, probably in 2 out of 5 cases. I don't hazard to know, but I don't think anyone's particularly delighted about the results they're getting at the moment. Sydney's preliminary auction clearance rate has dropped by 3.8 percentage points to 59% compared to a week ago, despite lower auction volumes. And in Melbourne, clearance rates fell by 1.7 percentage points to 61.2%, and nationally by 1.4 percentage points to 62.3%. Clearance rates have been holding below average in the main auction markets, which goes hand in hand with the weaker conditions we're seeing, and the higher stock levels in the marketplace are giving buyers a lot more leverage, Mr. Lawless said. Louis Christopher, SQM Research Managing Director, said its own data pointed to an even weaker auction result. I expect to see Sydney's clearance rates fall into the low 40s when the final results are in, he said. This indicates that the market conditions continue to weaken in Sydney and Melbourne, and sentiment will continue to slide after another rate rise on Tuesday. I think there are many disappointed sellers out there who are still wishing they could get their 2021 prices, but they no longer can. And if they want to sell in Sydney or Melbourne, vendors do need to meet the market right now. That's just the reality. It's a buyer's market in both cities. And across the smaller capital cities, Adelaide recorded the highest preliminary clearance rate of 75.8%, followed by Canberra with 71.1% and Brisbane with 65.2%. Despite the weaker sentiment, buyers still flocked to desirable properties, such as a house at 69 Lancaster Avenue, Punchbowl in Sydney's west, which sold for $1.8 million. That was $200,000 above the reserve. Ray White auctioneer Alex Patero said there were 14 registered bidders, with 5 actively competing for the property, which was eventually sold to a builder. Another successful auction was at 12 Woodside Drive, Rowville, Victoria, which was sold for $1.121 million. That's $151,000 above the reserve price. But Mr. White from Mennick White said it had become increasingly rare for vendors to achieve prices above the reserve. It's getting very difficult to get a price above the reserve in this market, he said. Occasionally we get a good result, such as an apartment I recently sold in North Sydney with a guide of $2 million, and that sold for $2.6 million. But that was a pretty unique property with a harbour view. I think those results are an exception to the rule, not the norm like we used to be doing during last year's boom. The expected interest rate rises this year will further weaken the auction market, Mr. Christopher said. Rising rates are naturally a negative for the housing market that's currently affecting Sydney and Melbourne the most, he said. While the other cities such as Brisbane and Adelaide are still relatively robust, they will also slow when rates rise by more than 1% this year. That's when we start to see broad-based housing price falls. It's going to be ugly, but I still think it's an orderly decline at this stage. And the decline in housing prices will accelerate further as higher interest rates and weaker household confidence drive a retreat from consumers from the home loan market, according to economists, after the latest figures show mortgage lending fell at its fastest rate in 2 years. New home loan commitments fell by more than expected, 6.4% actually in April, led by owner-occupiers down 7.3%, followed by investors down 4.8%, and occurred before the Reserve Bank's first upward movement in the benchmark cash rate in 11.5 years. Economists expect a further increase in the central bank's benchmark cash rate on Tuesday, and home loans will become pricier in response to tighter monetary policy, said CBA economist Harry Otley, who predicted a 25 basis point rise on Tuesday. We anticipate housing lending to continue to cool throughout the rest of 2022 as the RBA normalises the cash rate, Mr. Otley said. The monetary policy tightening will have an impact across the economy, including slowing lending and bringing down dwelling prices, with falls expected to accelerate from here. Figures recently laid bare the turning in Australia's residential property market, with accelerating price declines in Sydney and Melbourne, along with Canberra, which posted its first monthly fall in almost 3 years, to pull CoreLogic's National Housing Value Index down 0.1% in May, and that's into negative territory for the first time since September 2020. April's decline in new home loans, which economists said was worsened by the timing of the Easter and Anzac holidays, came after an extended period of strong credit demand and lending volumes remained high. JP Morgan economist Jack Stinson said credit growth should remain robust going forward as the level of new loan commitments are still well above historic norms, Mr. Stinson said. The April figure puts credit growth at over 8.5% on a 6-month annualised basis until at least October, materially higher than expected household income growth. But higher inflation is crimping households' ability to borrow more to spend on housing, on top of higher mortgage rates themselves, BIS Oxford Economics senior economist Marie Kilroy said. Households are currently seeing their cost of living go up with little respite visible near term. On the housing front for owner-occupiers, we expect the observed housing variable rate to lift 100 basis points, or 1%, to around 3.5% by the end of this year. That will add around $320 to the monthly repayment on the average new mortgage, which currently sits at around $600,000 nationally. Inflation was also hitting renting households, with asking rents likely to increase by almost 10% this year, Ms. Kilroy said. As borrowing costs go up, the mix of home loans is also changing. Fixed-rate home loans, which accounted for more than 13% of all loans before the pandemic, surged to 46% of all new home loans issued in July last year and has since fallen back to 16.4%, NAB Director of Economics Tapper Strickland said. Housing credit fell most in New South Wales, down 11% in April. Queensland and Victoria both fell 8.3%, while there were smaller declines in Western Australia at 3.5%, South Australia at 1.2% and Tasmania at 1.1%. And building a new home became a lot pricier for one Metricon customer when the company called and asked the Sydney couple for an extra $100,000 to build their dwelling that was approved but not yet started. That was a shock and gave no confidence about when their knockdown and rebuild project would be completed, one of the couple said. The reason was that the previous pre-site manager underestimated the cost, he said. I find this to be the most ridiculous excuse to recoup money from us. An underestimate may not be so far from the truth. Figures this week show that the costs of a new house rose by a record $76,715 in April from a year earlier due to the global supply chain crisis sparked by the pandemic and worsened by the war in Ukraine and further Omicron COVID-19 restrictions in China, as well as surging local demand. Whether Metricon and other home builders will be able to recoup those higher costs, however, is unknown. And another Sydney Metricon customer the AFL Weekend spoke to on Friday, who had not been asked for extra, said his contract gave the company no pathway to renegotiate. The company, which in March tried to renegotiate contracts with Queensland clients, a move it reversed after the state government said there was no legal basis for clients to pay more, said it would not attempt to alter valid contracts with customers. Metricon is committed to fulfilling every valid contract in which a fixed price has been agreed, said Patrick Ather, the company's general manager in New South Wales. But with the supply shortages affecting the whole sector, rather than just one company, there's no guarantee any other builder could take on a Metricon job any more cheaply than the country's largest home builder. A rule of thumb in a new home build is that materials account for somewhere between 45 and 50% of the total costs, labour 35 to 40%, and profit margins 15 to 20%, excluding land, taxes and other charges. Wholesale or producer price figures for the March quarter show the biggest material cost increases over the 4 quarters were in reinforcing steel, which rose 43.5%, structural timber, which jumped 39.2%, and plastic pipes and fittings, which gained 26.5%. The construction industry early on anticipated that the pandemic will push up costs of materials and labour, and it was right. Shortages of materials across the board were surging by mid-2021. A little-known polystyrene product used in housing slabs called waffle pods was particularly hard to come by, and in February, Simmons Group plunged into a first-half $5.2 million loss as a result of crimped supply of materials and labour, along with COVID-19 restricting on-site activity. In March, the invasion of Ukraine dealt a further blow to already stretched global supply chains when retailer Bunnings ordered suppliers to stop buying conflict timber from Russia in the wake of declarations earlier that month by global forestry bodies about timber from the country and its ally Belarus. Housing Industry Association numbers show that home building related trades costs rose 2.1% in the March quarter and were up by 5.1% from a year earlier. Bricklayers, carpenters and painters showed the most cost increases. The big exception in rising prices across the board was a 12% drop in the cost of trades for site preparations. This reflected the hangover from a year earlier when home buyers and builders rushed in the March quarter to kick off construction of their home builder subsidised dwellings. HI Executive Director for Industry Policy Gordian Murray said, "There was a massive spike as everybody tried to get their slab down," Mr. Murray said. The rising costs are now depressing home building activity in both home building and apartment construction, which fell in May, according to industry figures, as disrupted supply costs increased and difficulty filling positions pushed out projected completion times. Some home builders reported falling demand by customers concerned about price escalation and higher interest rates. The PCI report said, "One positive sign is that the pace of growth in building costs, inflation, may have peaked. The cost of materials isn't going to increase in the next 12 months like it did in the past 12 months, said HIA Chief Economist Tim Reardon. That doesn't mean costs will fall, as other economists have also cautioned, but simply that the rate of gain will slow, he said. This creates a separate concern. The delays pushing out new, already contracted housing work could encourage the RBA to raise rates higher than it would have otherwise done, because the sector will keep ticking over employing people and obscuring the effect of rising rates on the rest of the economy," Mr. Reardon said. "They risk overshoot," he said. "The lag between rate rises and decline in housing starts is more than 12 months, whereas in 2010 it was about 6 months. It's just that there's so much work in the pipeline." So, putting all this together, you can see that with interest rates on the way up, with prices on the way down, and with construction sector momentum still strong but under pricing pressure, it's a perfect storm. And I think it's going to get worse before it gets better. So I guess the message is, if you're banking on a particular price for a property, or if you are concerned that your building construction costs may be rising, you're probably right. And as to interest rates, at least 25 basis points, maybe 40, and some are now even saying 65 basis points tomorrow. We'll see. This is looking like a walking disaster area that's about to turn into a sprint. And if it does, home prices will fall even further. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.